Thank you, Darren. Today, I would like to offer up a big picture view of the economy. I have come from a uh, long history in the marketplace of experience. And if you look forward, uh, I see a lot of very positive developments taking place. I've had 38 years in the industry. I have traveled to 62 countries. The majority of those trips were on very specific individual commodity uh, discussions and involvement with physical production on the ground with those who handle the credit and the trade and the hedging of those commodities. And so I'm kind of a unique person in that I started in the industry at a point in which all the market analysis was internal in each market. The iron ore market would not pay attention to the value of currencies, would not pay attention to the price of crude oil. And now over that time frame, we've beginning with the globalization of the world, we began to pull these commodity markets together. And at this juncture, my presentation today is going to focus a lot on the big picture macroeconomic scenario because in the next 2.5 to 3 months, we have a very significant historical junction that we're at. And it's the impact upon these physical commodity markets. I think we're going to have a bifurcated world economy in which the cycle of equity markets gaining over commodities is going to reverse. We've had a significant rally in global equity prices. The stock market, in my almost 4 decades of market experience, has been one of the best predictors of where the global economy is going to go. And commodities have been in a deflationary environment. We have suffered from overproduction. And then we were hit by catastrophe when it came to the global pandemic. So global production overshoot, a demand destruction environment, a fear of a depression, global depression. So I would like to suggest that traders go back and look at pricing from the March timeframe and realize that that is more than likely the modern day low prices that you will see. And for many people, it'll be the lowest prices you'll see in the rest of your lifetime. Throughout history, throughout my 38 years of experience, you see these big events, and there's a form of technical analysis called GAN. GAN is a technical study that compares price and time. And it also gives waves of reactions in the marketplace. And I found over my experience that the fundamentals is track that similar type of ebb and flow in terms of cycle. And I saw this during the Chernobyl disaster, through 2 different financial catastrophes, the tech bubble and the subprime crisis. We've seen it in the currency, emerging market currency debacle. And that cycle and wave is this, that in the beginning of the major event, the panic reaches its highest levels. The uncertainty from the event is difficult to predict, and the duration of that threat is unknown. And so there's a tendency on the part of the marketplace to fear that it's going to continue forever. And so a lot of times we'll see the most negative reaction to the events and the assuming of the worst case scenario. And that's what happened January 18th through the middle of this last summer, is that the markets were reacting to the worst case scenario. So the January 18th awareness of the infection problem in China started the anxiety event. The March 6th official lockdown of the US, the largest economy in the world, accelerated the washout. And then into the summer months, when we began to see the predictions by China that they had effectively brought the virus under control in February, by the end of February, that is. Those began to bear out in their numbers. And so we began a long climb out in the equity markets as the risk of the uncertainty began to be narrowed by therapeutic treatment and advanced knowledge within the medical community. And now we're feeding a little bit higher off the hope for a successful vaccine. And we do have 4 vaccines in final stage trials, and some of them are different type of scientific methods. So that gives us some diversification in hopes that there will be a solution made for it. Science will get this. Containment, as proven by China, will work. The other less government-controlled economies, U.S. has freedom, too much freedom, and so therefore the citizens have not been going by the stringent protocol required to contain. So we have this first wave in January. The second wave of fear when the U.S. went into lockdown. We had a recovery off hope for the end of it, and now we're into the second wave slash flu season anxiety. And so I see that coming to an end here in the next month. A lot of times these major fundamental conditions combine, and we have a collection of events that take place within a compacted period of time. And we will have the U.S. election at the same time that we're going to be at the end of these final stage trials for the vaccine. And the UK has already indicated this morning that they may begin actual emergency use by mid-December. So we have this 30-day time frame here in which a lot of very significant developments can unfold. The U.S. payrolls as of that first week in November, also a very critical point, as we'll find out, is the U.S. economy still trying to grind its way through this crisis? And if we lift the veil of uncertainty from the election and we give some kind of end, a vaccine is not an instant solution, but what it does, it provides a significant psychological windfall for the markets. And so that means, in my mind, a buy the rumor scenario is unfolding in the equity markets. We will end up having a sell the fact condition in equities. And then we're going to see what I think will be a resumption of the global commodity rally. Now, think back, China was the primary catalyst behind that initial globalization, significant run up in commodity prices. Now, the second time around, we have a situation where China is already has the virus in its rearview mirror. It begins next week to put together another plan. The stimulus plan, again, with China now becoming more of an import driven economy, the Chinese demand for commodities has been lifting commodity prices, and you name them, aluminum, zinc, iron ore, corn prices across the board. And I think that's another thing that I offer that many don't. I also cover the grain markets. Anything that's an actively traded commodity market, the Hightower report does analysis on it. And that helps you because you can detect demand trends better by looking across a broad cross section of commodity markets and really knowing the internal developments that are taking place. Instead of sensational headlines that you derive your opinions from, you actually see the movement of commodities. Now, you can see speculation in equities. You can see cash moving into equity markets, but when you see the actual physical takedown of commodities and the consumption of commodities, that's something that's very difficult to discount as real. Now, China has been rebuilding buffer stocks that many have assumed here will result in some slowing of crude oil imports as we go over the next month. Many have wondered, how can we be importing this much iron ore into China? Where are you going with it? Are they using it to make steel? And in fact, we're not seeing inventories build at the end of that. So that tells me that there's inherent demand behind this scenario. So right now, And I try to offer my opinions of prices very early in my presentation, and then I give you supporting evidence for why I feel that way. And my conclusion is that prices, iron ore prices and steel prices, have anticipated the improvement in the global economy. They have thus far been driven by China demand and being held back by non-Chinese demand destruction. But in the end result, we will see this last phase of anxiety and uncertainty culminating with a vaccine relief. And what we will have then is a correction in iron ore prices, a correction in steel prices, and then the catching of that second wave. So for buyers of these two commodities and the profitability of those making steel, we may see significant profitability for steel makers within the next 35 or 40 days, because you're going to get your input costs to go down, and then we're going to see a very significant jump in the end product price as the rest of the world comes online. And the most important factor that I can say is that this time the world economy will have to focus on infrastructure and the use of commodities in order to make this recovery go. In the prior two historical disasters that we've had in the marketplace, those were financially derived incidents, subprime and excess speculation on the internet tech bubble. But this time around, it's a classic commodity driven economic recovery that we need to orchestrate, and that's going to begin with the purchase of cheap commodities and the implementation of those in a infrastructure scenario. So if we look to the Dow Jones Industrial chart here, you see those two gaps to the left, where you up to the upper left-hand side, those are the gaps, those are the anxiety, the Chinese awareness, the US lockdown, the fear that this was going to stretch all the way into multiple years into the future, all culminated in that March low. Then the US stimulus started to surface. Other countries provided stimulus. We started to get some therapeutic advancements, and now the markets are starting to look beyond, the stock market's starting to look beyond this crisis. So anyway, this next chart here is I'll go back here real quick so you can see it if you were not able to see this. So in the upper left, you can see the gaps that came down the stock market where we panicked, got overdone with that panic, and that March low is going to be what I would say is a modern day low in almost every commodity market, physical commodity market that is traded in the world, because we're expecting a depression and the worst economic condition in perhaps 200 years. Then we began to solve the virus crisis with medical advances, stimulus started to flow, and now we're starting to look actually beyond this crisis. And the next item, this is a new indicator, these activity in big data, tracking cell phones, tracking these real-time point of sale and other items. This is a really good indicator as opposed to these economic indicators that you get a month or so after the actual data is compiled. So you can see the upward slope there. Some of these areas have fallen off, and again, that's the second wave of this particular slowdown. But look where the trend is from the lower left to the upper right. U.S. home sales, here's another major thing, like Darren pointed out, is that you have a backdrop of extremely strong auto sales, auto production, and housing is also significant. And so these are all fed by low interest rates. And something that's very important to note about those car sales figures is the following, that especially in the U.S., due to the social isolation that we have, that there's been a significant surge in the demand for used cars. So we have a price lift that is taking place from the lower end of the market, at least in the US. And so this is going to clean out the supply that has typically been available in the marketplace, and it's going to turn, it's going to eventually result in the need for new cars. And so we're building up this pent up potential demand out there in the auto sector. And the next slide, this shows you what happened in the copper market. If you look at the copper warehouse stocks in London, you find out that during the crisis, what did we do? During the pandemic, we actually pulled down LME copper warehouse stocks, suggesting what? That these commodity markets had already effectively balanced their stocks. They were brought down even further by price signals that seemed to drive producers to not produce marginal profitable products. The next slide, here's Shanghai again. We had a huge jump into the beginning of the crisis. Then all of a sudden we came back and we have multi-decade lows in one of the major feedstocks in the economy. And so, as I said in the intro, look at other industrial commodity market fundamentals to see what we should be perceiving when it comes to iron ore and the steel market, and especially with being industrial type commodity markets. So you can see copper futures also went down and went back and tested those pre-crisis levels back from 2015, 2016, and look at where they're at relative to history. So prices in many commodities are extremely deflated and therefore capable of going up. So here's your Chinese automotive sales. And again, major contraction. I think the thing that's most important about China is we're beginning to see a number of statistics, aluminum and car manufacturing, some of these statistics showing we are running at a pace faster than last year. So in a non-pandemic year, some of the statistics that we're getting are stronger than last year. Now, granted, some of those are pent-up demand. Some of them are catch-up sales, but even the U.S. car sales are skyrocketing. Another thing to realize about the U.S. economy is that during this crisis, and I assume this is mirrored throughout the world, is that the financial scare of this situation resulted in a significant reduction in credit card debt and a significant buildup of savings. So in fact, with low interest rates, low commodity prices, significantly improved cash and spending. If you don't have a job, you can't spend. But if you do have a job and you do get back to work, a lot of the consuming capacity of the world is going to be very strong. And so as we go forward here, the first wave of commodity strength was global synchronized growth. The second wave of growth, as I indicated, is going to be because Chinese growth was joined by US growth, but the type of focus of the economy is going to be on the physical commodity side of the equation. So Amazon is very, very successful, exploding their business, and what they've merely done is they've facilitated the pace of consumerism. And in order to have all those products have to be manufactured. And so we're going to see a infrastructure type led recovery. And one thing that makes this particular situation a little special is that most of the central bankers in the world now are praying and wishing and hoping for inflation. They want to incite inflation. They will, as opposed to the difference over the last 30 years, they have promised that they will not react until they see inflation really beginning to become entrenched. And so this is a huge difference. Back in the 70s, we had an inflationary scenario that drove metals prices massively. And we had a Citibank forecast this morning of $40 silver. And so we are kind of setting the stage here for a wave that is accentuated by a number of different angles. So China is kind of forward bought here. As you can, the Baltic Freight Index has went up quite significantly. That's resulted in the markets forward looking into securing these products. The The Baltic Freight Index bottomed out back in early 2019, then it bottomed again as we had this crisis, and now we've seen basically a tripling of that index since the crisis low. So again, there's an inflationary scenario. From a shorter term perspective, the Chinese port congestion has cleaned up, so that wave of preloading for their recovery after they became very conservative on the crisis is now put their import, export, and inventories on shore in what I think is a balanced level. Many may think that they're forward bought, but I really don't see that as the case. I see that as back to normal. And I would make a comparison here. If you look at the corn market, a significant oversupply inside China in the corn market, soaring prices of corn in Beijing price for corn, that is. And now we're starting to see the big stocks level has now dissipated in the corn market, and they're now back on the import wire. They're buying a huge amount of grain from the U.S. And so they are making an impact on the grain market just by themselves. There has been some talk about how there's going to be a winter slump, and there's some dark warehouses in China. And so when you look at where the near-term price of iron ore and steel is, you do have to feel that we're a little bit overbought in the short term. And if we don't bring home this pivot point that I see in the next 30, 35 days, you are going to see a correction. And I do have some targets for that corrective action. And again, I think that's going to be an outstanding buying opportunity. And the question becomes, when do we get the non-Chinese demand for steel? When do we get the non-Chinese demand for copper? Because when that happens, you're going to send these price levels to a whole nother, even higher plateau. So China's bringing out that old construction infrastructure playbook. I think you're going to see a lot of it in housing. We saw 2 weeks ago that they came out with an indication they intend to build out in the southern provinces a unparalleled tech industry. And so we're going to kind of go back to these, not necessarily the full real estate play that we saw in some of the northern and coastal cities, but that's going to be a portion of what we see. And I think next week we're going to get a little bit of indication about how that's going to come down. The question is, it's slower to get the infrastructure spending elsewhere, as evidenced by the U.S. and UK and Canada. It just takes longer for these type of not as centralized governments to, with political debates going on. It's very difficult to get them in place as fast, but they're coming, just not as fast. So we do have some building ore supply here in the near term. The large shippers have kind of discounted that as we go forward. This October 26th through 29th timeframe is when the Chinese planarium is going to be seen. And I do think we're going to see a vaccine reaction in iron ore and steel prices, but we've already got a strong backdrop of recovery going in some of the key demand sources. So my conclusion is that if we see that we're entering a flu season without a vaccine, that catches us overvalued, which it has. Now, whether or not that'll send us back to $650 a ton, I doubt it. In order to see that kind of a corrective action, the macroeconomic picture has to fall apart. And right now we are, with China's assistance, we are leading our way through that. The U.S. data has continued to be strong. And if we get a stimulus from the U.S., that's likely going to put that 650 yuan, an unlikely target in the near term, and something like $750 is going to be more of a corrective buy point in our opinion. But if you get the deflationary pricing, that's $500. I don't know if you'll see that again in modern trading. But we were kind of priced for perfection for the fourth quarter. You see a real positive shift around here, and we weave our way through the next 35 days of key information. I see a $910 price. I don't believe that China's forward bought, and China will have a small supply deficit. And so that doesn't feed prices higher, that just cushions prices at current levels. So we have signs of recovery in India also, and we can't forget this. And again, I watch for signs like gold imports, amount of wheat imports, even LNG and heating oil imports into India. And so we're starting to see that, and we're starting to see a pickup in scooter sales. And so we're getting these non-correlated type of signals that give us confidence that they're recovering. So we have this January 2021 iron. We're a buyer. $751. We put a stop in there at 725. But as I said, vaccine or multiple vaccine pricing puts the January contract up to 900. And so the next chart here again, this would be a euphoria rally. Next 3 weeks, those going to bring a lot of angst and anxiety. Most of it from the U.S. And as we were chatting before we got started here, the market has probably factored in a Biden win, and if there is a Trump win, there could be a tremendous violence that takes place, and that would be enough to send that iron ore price down to the level which we predicted it would go. As we said here on the weekly chart, you can see perfection pricing up there. Perfection pricing, in our opinion, means Chinese growth only. To go above that level, we need the U.S. to join the parade. So prices, domestic steel prices, they're cheap. We're going to begin to implement this infrastructure spending. China's well ahead of the curve. They're anticipating what they need. And I would expect to see a lot of purchasers begin to preload what they need going into the future here on this 3-week break. Here's some hot steel prices. Again, not nearly as cheap as they could be. They are nowhere near that panic low that we've had. But again, look at 2017 and 2018 pricing. That should be achievable when you look at the fresh demand. We're going to have stronger demand for these particular products than we had back in 17 and 18. And all you have to do is go back and look at the pace of the economy. China's at a 5% rate, and where's the U.S. going to go with its infrastructure spending? The next item, so here's supply. Naturally, supply is holding us back, and that's why I suggested some of these recent prices are probably perfection pricing. So that's at a record pace. But again, we're absorbing this production. And as you can see, it was caused some setback here. There's been a lot of mines that have had difficulty because of containing the virus to keep that production up. And we also had a lot of industries that were beginning to pare down their production forecast because of their fear of bad demand. So if you look at Chinese iron ore imports, the 12-month moving average, so in spite of the COVID-19, they continue to go up. So demand overwhelms supply. And if you look at the iron ore concentrates, I think bargain hunting buying is going to continue. Strategic buying and maybe some inventory building is going to go in correlation with that. And also weekly Chinese iron ore shipments versus Australia. You can see that we have seen that build up, but we're absorbing that. You see the correction in prices here, largely a function of maybe some of these secondary infections, but also because the trade over the last 2 or 3 weeks began to talk up about how expensive these prices were. So this is a healthy cleansing break that we've had that creates this opportunity in terms of cheaper value. So here's a distinction with the rebar versus hot rolled coil. And again, if we see this housing industry and the construction of buildings become a little bit more of a portion of the stimulus than, say, some of the bridges and other major infrastructure projects, you're going to see both these lines begin to track significantly higher. And when you look at the rebar on warrant, you can see the implicit demand is already beginning to build for that product line. So if you look at the steel consumption inside China and find out where is it coming from, we've already seen this has been the mainstay, which is the construction. Look at the minimal size of the automotive contribution. And last week we noted that Ford had a 25% expansion in production, and this is something that's going to grow consistently. And there is a number of international companies that have begun to expand their production inside China. So again, that's why I believe that the second wave of physical commodity demand in China will overcome that of the initial globalization rally that took place. Again, it's a function of all demand sources growing at the same time, and that's very critical. So if we look at the next chart here, you see the volatility of rebar showing significant volatility relative to the coil. As I indicated before, I think you should be looking at the rebar as a leading indicator, because again, when you have a more volatile market, it tends to show these major turns in the marketplace. And you go back and correlate some of these wide peaks, volatility means something is going on within the marketplace. And typically when a lot of things are going on and prices are swinging, that means the markets are digesting a lot of critical information. And that's kind of where I see the trade at the current time. Usually when you see a bad demand forecast, that's because things are very quiet. Things get quiet when markets fall over. So if I take a step back and I put my timing back together again, I say to myself, look to crude oil, look to the copper market, look to markets like zinc and lead, which have no significant speculative interest. Some of these markets like the crude oil and the corn market have tremendous trading volume. And so things that are taking place there can be driven by a collection of money, funds, speculative interest, anticipation, and not necessarily physical reality. But when you look at, there's not quite as much speculative interest in copper, although there is a fair bit. But when you look at lead and zinc prices, you have a very minimal spec and fund positioning. And so when you have 5 and 6 year highs in some of these markets, you begin to get a picture of what's going on in the backdrop. So going forward, if we flip back, I'll bring you back to these price charts here. And again, it's the weekly chart here, perfection pricing. I believe that will not stand, and we get into the beginning of the first quarter next year, when you have these infrastructure programs probably beginning to reap some rewards in the marketplace, and we begin to unleash some of this pent-up demand from lockdown. And I think China's already seen that with these better year-over-year numbers. Once the US and UK with these consumer credit windfalls, then we're going to take out that perfection pricing. But in the near term, $910 is going to be difficult for us to surpass until we get a vaccine. Once we get the vaccine, then that won't be as difficult of an undertaking. And we go back to the daily, the January futures contract. As I said before, I want to be a buyer on a return back down to the September vicinity. And I'm going to be watching very, very closely for a sign that, in fact, there has been no side effects from this late stage trials, and they are going to begin the emergency use, because as in the Chernobyl accident, you have the major panic, you have a secondary panic, and then all of a sudden the markets basically are not immune, but they are tired of it, of all the uncertainty, and now they're beginning to see the end of that uncertainty. And that's exactly where we are today, is sitting at the end of this uncertainty. When it comes to steel prices, again, as I said just a few minutes ago, when we catch this second wave, when it's non-Chinese growth joining into the party, so to speak, we're going to be back up to those 2018 highs in fairly quick fashion. And who knows, if we get into an inflationary track, and the funds begin to see that it's time to rotate from paper assets into commodities, the investment by the funds could go into a lot more markets than it has in the past. Over the past 25 years, we've seen funds primarily, when they say they're trading commodities, they've primarily been into the crude oil market. And so now they have become more adept at diversifying this money. Whether or not they'll get down to every market that's in there or not remains to be seen. But never underestimate the power of fund money, because they can concentratedly buy. They probably have more risk tolerance than some of the physical users. And just the sheer numbers of a concentrated purchase by the funds can have a exponential impact on prices. So if you overwhelm a market that has dominated by commercial traders with buy orders, then all of a sudden you get into a whole different scenario. Next one, here's the hot rolled steel. You see where if we go back to those 2018 highs, you're talking at least a 10% rally back to those highs. And so iron ore will go first. At some point, that will begin to pinch back some of the steel production unless steel prices continue to rise. So iron ore leads, steel prices follow, and we probably have a very strong first and second quarter in terms of pricing in steel. So here, we're the Hightower Report. We watch all these markets in concert with each other. We try and use cross research so that we can tell really what's going on, get the heartbeat of what the world economy is. There's also considerations in this equation with respect to the currencies. I want to mention them on the way out because the dollar has become extremely cheap, may get extremely cheap as we go through the uncertainty of the next 35 days. And when you get a cheap dollar, sometimes that can be the exact catalyst that begins that inflationary scenario. And the last item is U.S. Treasury purchases by China. We saw back in 2018 a 5-month period of time in which China began to pare back their holdings of U.S. Treasuries. And what that resulted in was a tremendous jump in interest rates. And so I'm putting together the components of an inflationary scenario where central bankers allow inflation to come in, will not react immediately, but then we'll have trouble checking those inflationary expectations. And so that adds the final wave to commodities. And instead of being a long-term bull market in commodities, I think that leads to a very aggressive and compacted rally in the first half of next year. And maybe that well brings in a top, but I think that the magnitude of the gains could be very surprising going forward. So internally, we have met the supply challenge. There's been a short-term signature of supply coming from Australia into China. So that provides a little bit of a reduction in buying interest in the short term. So if I am pushed into the market today, I'm expecting a correction, but I'm also expecting a really solid buying opportunity within the next 30 days of trade. Darren?
Okay, thank you very much, David. That was comprehensive as always. I think we're now going to switch to Helmut Mueller. If you could share your screen, please, Helmut, that'd be great.